Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast. And today we're going to be working off our last episode, the foundations of a high-performing property selection. And today, scaling smart, growth, yield, and emotion. Today, Jez, I'm going to be asking you some rapid-fire questions similar to our last episode.
Well, I hope I know the answers.
You will. Okay, so let's get started. How do you balance high rental yields with capital growth?
My approach is I personally just ignore yields.
Mm-hmm.
I'm going after growth because as soon as I start trying to aim for a higher yield, I'm probably going to sacrifice growth. And to get an extra, say, 2% of yield, I might be sacrificing 5% of growth. So I'm just sort of shooting myself in the foot there. But if I was in a cash flow crisis, I might prioritise yield a little bit higher.
Yeah, I think the banks do have all their buffers in place. So yield isn't most probably too much of a factor of investors. I know there might be a lot of marketing out there saying you need the high yields, you need the cash flow because that's going to allow you to build your portfolio a lot quicker. And it was a series we did a while ago where we talked about yielding type markets, and it can be really restrictive. So you need to find that, I guess, nice balance. You do not want to sacrifice capital growth. That should be number one always.
Yeah, growth just seems to trump every other thing in property investing.
And I guess, have you ever compromised too much on one? Like when you've built out your portfolio, when you started, when did you start? Back in
2002, I bought my first, and I had a very yield-focused approach. I think it wasn't until probably 15 out of the first 16 properties that I bought were all I'm just focused on yield, and that did end up shooting me in the foot. And the better properties were the ones that had the capital growth, and that was more by chance than design.
And before I touch on that point, we're in the new studio. I should have started the episode. So we've got the new studio. It looks very flash, doesn't it?
Yeah, big TV.
A lot of work done into it. So we thank our marketing director, assistant to the regional manager for, putting it all together. So make sure you give a thumbs up on this episode. And we really appreciate the hard work. But back to that point on yield, back then, 2002, you would have had a ton of markets with strong yields. It would have been very hard to shortlist, back then.
It was pretty similar to what we've got now. You would have to go regional if you wanted to get good yields. There have been occasions where I remember 2012, 2013, this is just before the Sydney boom, the postcode 2770, where I grew up, that was popping up a lot. And you could buy a house for something like $300,000 and get a yield over 5% in Sydney, which is unheard of now. But you go chasing the higher yields and you're really restricting the rest of the market. You're eliminating an enormous amount of the rest of the market, which could have fantastic capital growth just to gain a couple of percent extra yield.
But how would have, you were back in Sydney in 2002, were you looking borderless, for example? You able to go, okay, I'd identify this area because of these statistics or not?
No, that was my first property. I didn't know what I was doing. So it was a case of just buying somewhere I knew. I think I can remember one thing that I liked was being on a train line so I can get into the city from Sydney's west. So, I looked at a few suburbs that were on the train line. That was probably my only criteria. I really did not know what I was looking for.
And the other thing I was going to mention was the context ruler. So we could always look at the context ruler. Did you want me to bring that up?
Yeah, actually, that'd be a good illustration of what I'm talking about here when I'm saying in the pursuit of higher yield, what are you sacrificing? So it really does. Yeah, can you bring up a context ruler of the yield?
Yeah, so I'm in our new platform that's going to be released very shortly. So this is the beta version at the time of recording. But let's say we're looking at this month's data. We're looking at the new demand to supply ratio 3 score.
Yeah, can you change that to yield?
And let's change that to yield. Change that to gross rental yield. And now we're going to hit get data. All right, now let's see.
I don't know if they're going to be able to see this, Damo. You might have to zoom in a bit on that.
So we do the zoom in.
Yeah, but the point is, so you can see that distribution there, where what have we got? Median is 3.9%. There's an average of 4.3%. So
This is for houses though.
for houses, yeah, Australia-wide, where we could calculate a yield. You can see in the bottom right-hand corner, out of 6,283 markets. So there are an enormous number of suburbs around the country where we cannot calculate a yield because maybe there's no rent, maybe we can't even calculate what typical values are. But you can see that in some crazy locations, probably an anomaly due to Airbnb or something, you can get a maximum yield up there in the double digits. I wouldn't rely on that. But what we're looking at here is...
well, let me simplify this really easy. As you hover over the context ruler, this is what we were talking about earlier, is if you just hover over here, I'm looking at the higher yielding markets. So anyone can obviously jump on the YouTube to watch this or Spotify, but in the Apple Podcast. But we're looking at yields on a context ruler, and the further up that you go, so let's say we go up to a yield of 6.3% and 6.7% in between, there's only 464 suburbs above that value, and below that value there's 5,700. So there's a lot less markets at that higher range. So the higher yield you go, the more markets you're compromising on, which could impact your capital growth.
That's right. If you were pursuing genuinely cash flow positive property, you would be ruling out more than 90% of the rest of Australia. And what are the chances in that 90%? There is a market that's going to give more than an extra 2% capital growth than this market.
The way I would balance that out, I won't go through the heat maps now, but I was thinking the way that you would do it is like I found my market, I found my pocket, and we're not looking at isolated suburbs. We're not looking at a suburb in Perth, Adelaide, Melbourne. We know which sort of SA3 that we're going to be targeting, or SA3, significant.
Statistical area level 3.
I always forget that one. I always know the LGA. That's why I say LGA, but you always correct me with the SA3.
Well, SA3 is very similar to an LGA in most cases, in size.
So once I've found my cluster, let's say I've shortlisted to 5 suburbs, then I might go, if yield is a big challenge for me, then I might pick the top 2 suburbs with the best yields and just focus on those markets if that extra 0.2, 0.3% extra yield is important. But I'm not really fussed about that.
Yeah, it's when you start getting obsessive with yield that you're likely to shoot yourself in the foot. It's all right to pursue higher yield, but not at the expense of like capital growth. So the difference between 4% gross rental yield and 6% gross rental yield, you're thinking is 2%, but after tax is probably a little less than that. And after, to target that sort of high yield, you are going to have lower net yield than, for example, if it was a 3% gross rental yield, the net yield wouldn't be too much different to that. And what you're doing is eliminating an enormous number of suburbs that could have 5% better capital growth. So why would you aim for 2% extra yield at the expense of 5% capital growth? And
the rental yield isn't factored into the algorithm, is it? It's separate. Is that right?
In some way it is in there, yes, but not
Heavy.
How most people would assume.
Yeah, got it. The other one is, I think I've spoken to you, stock on market. Stock on market percentage is in the algorithm, but not stock on market.
That's right, yeah. So it doesn't really matter how many properties for sale, it's how many properties as a percentage of the area, yeah.
All right, good stuff. So how does leveraging equity help investors scale faster? So I think this is more for people just starting out, but capital growth, release the equity, go to the bank and get that money out quicker, correct?
Yeah, that's right. One of the beautiful things about real estate is the leverage.
And I think we've spoken about this as we, grow the business and we help clients. We're thinking after 18 months, if your property, I think 18 months is that sort of sweet spot to get a valuation done. Like you at least want to be beating the national average after that period. You get a valuation done, you go back to your broker, how much equity have I got into my property? Because that's really how you assess the service, isn't it? Because initially you might be a little bit skeptical. I'm not sure if I'm doing the right thing. Have I bought a great property? As you might see on Instagram, people go, I've just purchased a fantastic property. You don't know it's great till
Yeah, at least 18 months.
18 months. You
Yeah.
want that capital growth. That's really how you assess a really good buyer's agency firm, I believe.
Yeah, yeah. And after 18 months, you also know whether you've made a mistake, and you can start thinking of, well, do I cop that on the chin, liquidate and try again?
Pivot.
Or is it just one of these, you think it's going to come good in the long term kind of?
And we've got plans on how to help clients assess their portfolios in the future too. So that's not going to be too far away, because that's another thing a lot of people don't really sit down and review is how is my property actually performing? And once you see the numbers, it's like, damn, it's not growing or it's below the national average. I've made a mistake. Do I have to pivot? And what type of growth is there moving forward?
Yeah.
Do you always recommend pulling out equity when available?
Well, as long as you can afford it, I think, yes. There's never really been a time in Australia's history where there isn't a good market to invest in, at least not in the last 30 years that I've had access to that sort of historical data. So there's always somewhere where it's a good time to buy in that area. So if it's not going to hurt you from a cash flow perspective, yeah, I would. But you've spoken to a hell of a lot more investors than I have. What's your spin on that?
I think it's more what are they going to be doing with the funds? Because if you just go back to the bank going, hey, I want that equity, well, they're going to know what's it for. Is it for a Lamborghini, Ferrari? Is it for a holiday? Is it to pay it for a car? So it really depends. And the lenders are very tight on that anyway. Look, I think for me, would I do it? I normally mostly just do it when I'm maybe looking to purchase again or if I need those funds. So look, if you're looking at a car, for an example, like I'm looking at a car at the moment, I'm thinking, okay, well, I can just take money out of my offset and just do it that way. Don't really want to get a car loan if I don't have to. But then again, I lose that liquidity in that cash where, if the market falls down, the share market, I could maybe inject some money in. So it's pros and cons, but I sort of just leave it. I'd get valuations done when I may be ready to go. But I do want to understand how my properties are performing. And the whole trading thing we've spoken about, and we're going to do a whole series on that because the recycling costs or the what's the word you use to
Reallocation of equity. Yeah, so selling a property and then buying elsewhere, replacing it. Yeah.
the capital gain. So I think that's important because it's like, when do we jump out of that market? It's not like shares where you can just sell down. Property takes a lot more legwork. But if you don't foresee that growth moving forward, well, maybe it's time to pivot if you want to be a bit more active.
Yeah, yeah. And there is this peculiar phenomenon in holding long term. So the longer you hold a property, the more likely you are going to get the average sort of growth rate. So over the long term, all properties, all suburbs, all cities, they all tend to grow at the same rate. So if you want to get ahead, you have to actually trade property. You have to sell, buy elsewhere.
So from your experience, what's the best way to accelerate capital growth?
Well, I'm dependent on the market, but so you've got to choose carefully up front to get into a market that is going to grow, even that is growing. Accelerate.
The main thing here would be maybe if you wanted to do like a renovation would be at the top of my pick. So
Right,
you could do it
yes.
yourself or you could outsource it. So let's say you're a borderless investor, you live in one location, decide to buy in another state. You could lean on your buyer's agent or your maybe property manager to get all the quotes, get everything sorted. Look, it might not be perfect. You don't need it to be perfect. But if you can really just add that value, coat of paint, maybe the floorboards, the curtains, tiling, whatever it might be, that's where you lean, I think, on a property manager a lot. And that can increase, I think, the rental yield.
Yeah, so I would call that like a capital injection. Manufactured equity.
And the other one is obviously maybe if you did decide to do a development, but everything's getting so expensive and how active that you want to be. A lot of people are time poor.
Yeah, with my first few properties, I renovated those. I think it was after the second one, I thought, yeah, I'm not going to do that again, just because I was there doing it was a DIY reno.
I have to see that. Have you got photos of that?
No, but I can just remember you get home from work and then you're off to the property, and then on weekends it occupies all your time. Much better to just pay someone else to do it for you. It gets done so much quicker. They've got all the tools, they've got all the experience. They're not going to make the mistakes that I made. And I think ended up renovating maybe half a dozen properties. But that was my big thing, buy a property that's a bit dated and then, renovate it to manufacture growth. That was back in the day where I didn't know what the drivers of capital growth were. So I wanted to manufacture growth.
I'm not opposed to both strategies, and I think it's really up to the investor to decide. So look, you can buy something run down, and it most probably will still come under competition. None of this under market value or off market, like these markets that are seeing growth now, it's going to be competition. We know that. So when you hear marketing under market value, it frustrates me.
Yeah, every under market sale is a kick in the groin to capital growth because everyone has access to that sale information. So buyers can see it, obviously agents see it, and the next buyer thinks, well, that's what I want. I want to buy under market value. And so they turn their nose up to the more expensive properties, and it could actually, could start an avalanche in prices. But where demand exceeds supply, they just say, go away. Come back when you got more money.
And back to the point of you can buy something that's renovated. And I'm not opposed to that because there's no headache. You just get the tenant in easy. But you just got to make sure you don't overpay. You know what I mean? If you overpay a little bit, that's okay because the capital growth is going to be there. Like in 6 to 12 months, you're going to forget about that anyway, because you mostly will maybe see more competition on those more renovated properties. Oh, that looks pretty. People get emotional with it. Maybe a bit more of that owner-occupier appeal. But I also do like the other way where you find something a bit run down that you can fix it up. As long as the property is structurally okay, that's the main thing.
Yeah. I would much prefer to overpay and get into a hot market. 6 months later, it looks like I got a bargain, rather than overpay and 6 months later, it looks like I paid too much.
Have you seen investors chase growth too hard and get caught out?
Yeah, I've been one of those. Yeah, I've taken a few risky options myself, and probably shouldn't have been that desperate for it. It is big dollars that you're playing with in real estate. Other investors, well, yeah, I can remember hearing the stories of people who bought in some of the mining towns prior to the collapse, not exactly a collapse, but decline in the resources sector, and properties that were worth like $900,000 in Karratha, half the price, a couple of years later. It's just,
Got sold
horrific.
on a yield maybe back in the day.
Yeah, they were looking at almost double-digit yields, yeah.
I would think the only way, and it's most probably just not educating yourself as an investor, that you're going too aggressive and you've bought these properties and they haven't performed. So you bought one and then you bought another one. And the worst is when it's off the plan. So that's like a double whammy. If you get a little bit of capital growth, great, but they're still going to be underperforming assets. And we've worked with clients in the past that have come to us and we've spoken to them about that. So you want to assess like your current properties that you have. You want to make sure that growth is, that you've had a decent amount of growth, and then you work out, is it going to have growth moving forward and should you offload it? So I think just going too aggressive on underperforming assets can really hold your portfolio back, because then you got to sell down, you got to start up again. And there's nothing wrong with that. Like my first property back in 2009 had the same thing. I'm thinking, why isn't this thing growing? Western suburb of Sydney was firing around, I think, 2013, 2014. I'm thinking, these markets are firing, but the one I bought in Gold Coast is doing nothing.
Opportunity
cost. And then you just start thinking, why? How? Now, I guess talking about, removing emotions from investing, what are the signs an investor is making an emotional decision?
Yeah, I think, there's two I can think of immediately. Like they like an area because, I don't know, they got a nice coffee somewhere, or someone was friendly to them at a shop, or they like the parks, or the tree-lined streets, or that there's 3 schools to choose from. A whole bunch of things that are just emotional. They're like lifestyle sort of things. Maybe it's near the beach, but they're not the sort of things that investors should be focused on, which is risk, growth, and yield. And then the other end of the spectrum, they may turn their nose up at a perfectly good suburb to invest in because, it's got a high crime rate. There's too much public housing there. I saw some people wearing Crocs and Ugg boots, stupid things that have no correlation to the three things that we're interested in, which is risk, growth and yield. And I can remember I was presenting some suburbs to some buyers agents years ago, and the suburb that I was recommending was Corio in Geelong. And one of the BAs said, "Oh, Jeremy, I wouldn't drive through there without bulletproof glass," which, I thought was pretty funny. But, they decided to buy somewhere else. And I can remember looking up, I can't remember where the alternative was, but I compared Corio to their alternative. And just 2 years later, it was staggering the difference. Corio had double-digit growth and the suburb they picked out was pretty much flat for that period of time.
Well, it's a matter of how they're picking their suburb, and that's the biggest thing, isn't it?
Yeah, that's right. Yeah, and there's some legitimate complaints when you get into a market which does have, you're recommending to an investor buying this market and it's got a high crime rate, and they might think, well, surely that's a terrible market, and they'll be thinking, I don't want a tenant that's kicking holes in walls and does a fly-by-nighter. So, first of all, we will pick a market that's got a very low vacancy rate, obviously. Renters will struggle to get into those sorts of markets, so they're not about to kick themselves in the butt by kicking holes in walls. They are going to be well behaved because they're just making life difficult for themselves. And there are three things you can do to protect yourself anyway. One is obviously landlord's insurance. Number two, you choose an excellent property manager. Actually, on that topic, first of all, I'll mention number three. Think of how you would choose a good property manager. And number three is don't be too aggressive with your rent. So if the property manager suggests, you can get $500 a week in rent here, advertise it for $470, you get a lot more applicants. Two or three of those are probably going to have a very long, reliable, stable track record of renting. So you pick them, and that's more or less problem solved. But how would you choose a good property manager?
Property manager or tenant?
Property manager.
Well, that's a good one. Well, there's obviously Rate My Agent out there, but again, that can be a bit hit and miss, and there's a lot of marketing out there. I've got professionals around me that I'd lean on depending on the area that I'm investing in, so that would be the way that I would do it. Look, I've had experience before on one of the properties where I think I've mentioned to you before, a trial and error for me. Like they were trying to find a tenant, and then I just had dramas, and then I'd get a report saying at the end of the week, "Oh, congratulations, you had 0 tenants." I'm like, okay, so I'm getting this something that's automated, didn't feel very personalized. I think maybe the property managers I have at the moment, very responsive. If anything goes on, I hear about it via like email. If it's something small, I just let them deal with it. But I think trial and error is my way. What do you think?
Well, being a numbers guy and short on time, I'd just pick the most expensive on the assumption that they will give me better quality service. And I'm not talking about I want to be in touch with them all the time, hearing about the property. I want them to choose a tenant. I want them to be completely frank with me and say, Jeremy, you're asking for too much rent, or here's the rent. We would have to go as low as this in order to get a dozen applicants so that you can pick the best one. And this is only if it's one of those markets where I think this is a lower socioeconomic demographic. There is higher crime. There is more public housing. So I just need to be careful in who I choose.
The other thing is you can maybe go on like realestate.com and look at maybe what has been rented on CoreLogic, RP data, or if you go to realestate.com and see what is actually being rented for. And let's say there's 5 properties on there with the one managing agent, or there's 3, then you might lean to them first because there's a higher volume that they're looking after, so they might already know that pocket. So,
yeah, I like the idea of leaning on the experts we know.
The other thing, I guess, from making the emotional decision. So for me, it would be, because there is so much noise out there, who do you trust? Who do you trust? Like you do, you go on Instagram or you go on Facebook, whatever it might be, TikTok, what are the other ones out there? Snapchat, I'm not even sure. But they're spending a lot of marketing to get in front of your face saying how good they are.
Yeah.
Okay.
Yeah.
And
There's a
they've
lot
got
of,
their own way and they've got their own education. So one company, us, competitors, whatever it might be, we've got our own way and our own systems. And it's all about limiting that risk. That's the main thing. And even like property courses, I'm seeing them pop up all over the place. And like, how do you know that person, whatever they're saying, is accurate compared to this person, compared to this person? One might look at, like you said, maybe it could be like that's why I'm a very big fan of clustering instead of just looking at isolated markets, because they're just sort of handpicking, where I like to get a lot more of that probability. And you just can't be, even though we're numbers guys, at some point you just got to make the call and purchase that property within that suburb. Because you just have to make that call, don't you?
yeah. So you're talking about the analysis
And
paralysis.
that's a big one, analysis. And then it can work the other way where it's like fear of missing out, where you just jump in too quickly. So it's just that fine balance of get into that suburb, get that right property, rent it out, forget about it, review it in 18 months, get on with it.
Actually, I thought of another one. What about the, I don't know that area. And they invest only in their backyard because I don't know that area.
Well, that's a good one, because how many people do you talk to going, I live in, let's just pick a suburb, Jez. Just say Cronulla. Let's say I live at Cronulla. I want to buy a unit in Cronulla because I've lived there and I know I know Cronulla very well, as an example. That's all they know. Like, what do they know? They don't look at data.
Yeah, I would ask them, what is it you know? Do you know the relationship of supply and demand in that market? And they look at me strangely, go, no, I know where the good spots are to buy and where all the bad spots are to avoid. But you're after growth, yield, and low risk.
So, for example, like let's say you lived in, let's just say New South Wales. You lived in New South Wales. I don't know where. I'm just looking at holistically. And let's say you have an option. You can either rent in a unit there, or you could have bought something. Now, if you bought a unit in New South Wales 3 years ago, you would have had 9% capital growth over 3 years. But you could have rented a unit in New South Wales and made, for example, 46% on an investment in WA. You could have made 45% in Queensland. So this is the whole rent vesting. Like where you live, it's going to be a very, very low probability where you live is going to be a better market than anywhere else in Australia.
Yeah, you've got thousands of suburbs to choose from. There's a very good chance in my entire life I will never live in a suburb that happens to be the best suburb to buy in, to own in.
But again, we will do a separate episode on this. I think there's nothing wrong with having your stability, having your owner-occupied home, not getting kicked out, like moving. You got to add a bit of time and value into that also. But if you're really strapped for cash and you're growing your portfolio and you want to grow your wealth quickly, you need to take these things into consideration, because how many times, like I said to you here, I've grew up in the Sutherland Shire as an example. I want to buy there because I know it. But they don't think of it from an investment perspective. So what's their goal? Do they just want to have that stability and they're not worried about wealth? Or do they want to build that wealth really quickly to try and reach that freedom to get their time back? Because at the end of the day, why are we investing?
Yeah. And there's this issue when you do know your backyard very well, all your only strategy there is to buy well, like to not overpay. Oh, I know the area. I know this is too much for that property. This one's a bargain. If that's the limit of your strategy, then it's over as soon as you've purchased. So then what have you got to do? To repeat that, you can't sell it and then buy another one because you're just turning over. So you are dependent on capital growth. It's after you've purchased. What happens then? That's what's important.
The ideal scenario is you maybe go into a market that's like I said, WA units or houses or whatever it might be, if we look back at the data, and you might live in that market and then you get that capital growth too, and then you might offload it and then you avoid, I guess, capital gains because your principal place of residence. And then you can take that cash and then shift it to a different market. So
yeah, that's if it happens to be a hot market.
Hot market. Yeah. Have you talked a client out of a bad deal due to their bias before?
Surprisingly, I don't get feedback. Like a lot of people ask questions, and I don't know what they do in the end. Actually, one of my friends, she had bought a unit in Sydney, and she didn't like how much Body Corporate was charging,
Mm.
and she wanted to sell that unit simply because of the Body Corporate fee. And admittedly, it was quite high, but I mean, gee, we're talking single digit thousands of dollars a year, whereas capital growth is worth, tens of thousands, if not hundreds of thousands. And I checked the area for its demand to supply ratio. It looked pretty solid. And I think I managed to talk her out of selling that and buying elsewhere. It seemed like a trivial reason. There was another case where a client wanted to buy in a particular suburb in Brisbane. There's nothing wrong with the suburb, but their reason for buying there was there was a business park that was being built, and they believed a whole bunch of new jobs are going to be created. And it was in Richlands in Brisbane, and I think there were 500 extra jobs forecast to be created. So I just looked at how far do you have to be in Brisbane before it's not far enough for you to commute to work. So you're not going to pull up your life, take your kids out of school and move closer to Richlands because that's where you work, right? You can commute. The worker pool there is in the hundreds of thousands. So how many people are actually going to uproot their life, buy real estate in Richlands because this is where the business park is? It was just an absurd reason to buy there. And I suggested some alternatives. This was a buyer's agent who had a difficult client. So they asked me if I could do the research on that. And I think I was able to talk them out. But I can't think of any classic examples where someone was saved from $200,000 of no growth or backwards growth.
Yeah, I remember years back I spoke to a client and they were about to buy an off the plan. I think there was a contract and they ended up getting out of it, but in Tarneet. And everyone in their working field that he worked with were buying all these off the plans, and I think his boss was telling him to buy there. So I don't know what was going on, and he ended up getting out of it. I think it was like 250 square meters, like a house out that way, which is stuff that you don't want to be purchasing.
It's a cubby house.
And he ended up getting out of it and he was very thankful. So we did analysis there. And there was another one, I think, south of Victoria, again, a while back ago, and similar sort of thing, off the plan, small blocks. So we preach about it. It's not rocket science. Get some good land content, structurally sound, rent it out. Like that's the passive way. None of this magic tricks. Hey, I know this or that. Just get in.
Yeah. The big one is, we're getting a massive discount from the developer here.
And I think the cash flow thing that you mentioned earlier, like you just can't look at it from a body corp perspective, because how many times do you hear people say, oh, my property's giving me back $20 a week, it's fantastic. Well, what's the growth that you're foregoing on that allocation of cash of, let's say, 500,000-600,000? You need that capital growth because otherwise you're going backwards. Put the money in the bank, risk-free.
Yeah, I mean, $20 a week is $1,000 a year. Just 1% capital growth on a $1 million property is it pales in comparison.
So when data and sentiment clash, what do you do? So can you share a time when you went against the crowd or it turned, and how did it turn out?
Oh yeah, that Corio example, that was a good one.
Tasmania, I remember that one. I was in
Hobart.
that conversation with you too, and like, Tasmania wouldn't go there. Guess what happened through that period?
Yeah, they were saying, it'll be all over in 12 months.
And I remember coming to the office and I couldn't get lending at the time, but I remember houses were like around the $300,000 mark around Hobart. I'm like, Jez, I want to get in, but I just couldn't get lending. I should have got private lending or something at the time.
Yeah, fantastic growth and great yields too for houses. Yeah.
Is data still useful when the market's running on emotion? What example would that be?
I think data shows you whether it's running on emotion. It could be terribly overvalued.
Or maybe, how about another one is like, let's say here on the news, like everyone, it's tricky because I guess there's different channels all over the different states, but like Victoria most probably copped it pretty hard because of the whole COVID thing. So A lot of people are like, oh, I don't
The
want to go
land
there.
tax.
But the land tax is obviously, as we know, nothing.
Yeah, yeah. So that's a good example where emotion, you're thinking, oh, they don't like investors in Victoria, but it's trivial sort of stuff, and you've got to look at the opportunities.
And at the moment, they've got the biggest infrastructure spend, and I think people will pivot away from, I guess, Sydney becoming, and even the other states like Perth and Queensland, to an example, where the rents are rising so quickly. You know, people may be coming from overseas or want to pivot somewhere else. They might be like, you know what, I'm going to Victoria.
Yeah, yeah. Why
Weather,
not?
well, people don't like the weather there,
Yeah.
so that pushes. Well, was it bad when we lived there a
It's
while
just
back?
always windy.
Yeah, the 4 seasons in one. I remember it's like sunny and then windy.
9 months of winter. I couldn't put up with the 9 months of winter.
So how do you stay objective when clients or buyers agents are getting caught up in the noise? I guess it's really their decision, isn't it? Like, we can try and guide and help as much as possible. But if they get caught up with the property course that they've done, or buyers agents they listen to, or all the marketing noise out there, well, that's on them. Like, all we are there to do is to try and help as much as we can.
Yeah, I'm getting really sick and tired of the noise. It's just, it's like there's this limited number of investors, and you've got all these entrepreneurs trying to grab their attention, and it's like, who can be the loudest? And there's just so much BS.
We'll get there. We've got some big things coming, so we're looking forward to it.
Yeah, yeah.
So I guess the summary for me is focus on the fundamentals, stay objective, and don't let emotion drive your next move. That's it for me.
Yeah, that's a good one.
All right. So, Jez, where can listeners go if they want more resources?
Well, if this is the sort of thing you're interested in, please let us know. Click on like, and then you can subscribe and get notified when we've got another podcast coming out. And share this with someone else if you can see they're about to make a mistake. You could be their saviour.
And make comments like in the comments section too. We're going to hopefully do some more Q&As and spend a bit more time on our marketing. We haven't allocated a lot of time to it, but we will be spending a lot more towards hopefully the back end of the year. But that's all right. Like, subscribe, share to anyone interested in property or finance. Thanks for tuning in, and we'll catch you in the next one. Take care.